day, everyone, and welcome to our semi-annual letter for 2022. We will be discussing the last 6 months in markets and for our funds. It's certainly been a particularly eventful period in global markets. Often in markets, you have a long quiet period followed then by an extreme change in a short period of time. And this last 6 months has certainly been one of those regime changes. If you look back at over the 14-year period since the global financial crisis in 2008, it was quite a unique one in markets where central banks had a disproportionate impact on market levels globally. We effectively had central bankers believing that they could smooth out market cycles and economic cycles by, in any small pullback, printing more money, cutting rates, doing quantitative easing, and eventually in COVID, doing direct handouts and checks to individuals in the economy. And what this led to is a period of fairly low volatility over the last 14 years. And it led to a period in markets where, as a market participant, you could fairly safely buy any small pullback, knowing that the Fed would be there to bail you out. This fairly rapidly changed over the last 6 months. And the key thing that changed was inflation. Inflation's now at a level where it's the highest level in many years, and central banks simply have to respond. You cannot just cut rates and print more money. When inflation is here, you'll end up having governments losing elections. Consumers will just not accept the goods they buy going up at 8-9% for an extended period of time. So this means one has to reframe how you construct a portfolio and how you manage client assets in this period of time. And that's certainly occupied our minds over the last 6 months to ensure we do best for our clients and create a portfolio that preserves client capital in this period, but also positions clients well to benefit us coming out of this. Fortunately, the last 6 months has been great. Our funds are up 4 or 5%, the high growth, the pure hedge mandates, and that's versus the JSE also index down about 8%, and global markets actually down about 20% over the last 6 months. It's really been a tricky time in markets. Let's get into some of the details of what transpired. Justin, I'd love you to give us some intro into inflation, which really is the key theme right now. What's caused the current inflation and how is that impacting markets and economies?
I think it's important for us to focus on how we got here and how we resolve the current inflation problems that we've had. So in terms of how we got here, the combination of the central bank money printing that you referred to, the underinvestment in commodities for the last decade, the war in Ukraine, and these consistent COVID lockdowns that we've observed in China has resulted in the highest levels of inflation that the world has seen since the 1970s, which is an extremely scary prospect. Now we have to think about how we deal with that. And the only way to deal with that, which is an extremely blunt tool, but is through rising interest rates. And when interest rates increase, there are 3 very important implications for share prices and for companies. The first thing is that we have demand for goods and services that reduces, and that obviously impacts company revenues and company operating margin in a negative fashion. The second thing is that companies with debt typically have to refinance that debt at much higher rates or funding rates, which ultimately results in negative per share earnings growth for those companies. And the final thing is that rising discount rates as a consequence of rising interest rates serve as gravity to pull down company valuations and company share prices. So it's a very scary prospect, but it's not all doom and gloom. And I think it's important for us to focus on the steps that we have taken to position the portfolio in the best possible way to both preserve and grow investors' capital.
Maybe to get into some of those changes. In my head, the first thing that changes is uncertainty has significantly increased. There's various scenarios that can now play out. I mean, we're quite concerned about a scenario where potentially inflation stays somewhat elevated for an extended period of time because of this underinvestment in commodities. But on the other hand, there is a chance that central banks hike rates so significantly that it really destroys demand. In that case, inflation can fall back rapidly, but that probably leads to a big fall in markets because of the demand destruction that's happened. So if uncertainty increases, the best short-term way, in my opinion, to deal with that is to have increased cash and somewhat lower risk on the portfolio. So early on in the year, we took the action to significantly build our cash piles and to reduce our net exposure to equities to admit uncertainty has increased. Let's be ready for various circumstances. And I think having that cash ready has been great. We've already found a few short-term opportunities you could utilize in that time with higher cash balances. And I think it'll remain an environment to be somewhat cautiously positioned with higher cash balances. Another key change is then applying our minds to say, what things can we know with pretty good certainty? And the clear outcome of this Russian-Ukraine invasion is that the world will be somewhat short of energy. Russia is a massive exporter of oil, of gas, and of coal. And with sanctions on Russia kicking in 1st of August on coal, and then later in the year, or 31 December on oil, it was highly likely that the world will be somewhat short of these fossil fuel commodities, and the world needs that to generate energy. So we've got a big position in the portfolio that's exposed to coal to benefit from the fact that SA Coal is really helping wean Europe off of the Russian energy situation at the moment, and it's been a great contributor so far this year. I think those are two of the changes we made. I don't know if you've got a few more that you want to touch on.
Yeah, I think it's important to understand that in this type of environment, a bird in the hand is worth more than two in the bush. So we've dramatically reduced exposure to anything that does not generate profit at this point in time. Companies that don't generate profits in this environment have got a lot of question marks we need to ask about future funding requirements for those businesses. So we like companies that self-fund with their own earnings. We also love companies with very strong balance sheets. So we've increased exposure to companies with rock solid balance sheets. And then the final thing, which I think is very important, is to try and take advantage of opportunities with pair trades. In essence, we are able to express our views and put gross exposure on the table without taking market risk. And the hope is obviously that we can generate really good returns that are independent of the direction of the market, which is what a hedge fund is supposed to do.
And look, I think we've spent a lot of time here talking about the macro, and some periods in market history have more macro influences than others. And I think this is certainly one of those where it pays to spend a lot of time on the macro. But I think we shouldn't lose touch of what's really differentiated us over 24 years. And it's really been bottom-up research on companies, digging deep and finding good stock-specific ideas. And we certainly have continued to do that. And historically, periods of volatility, and especially periods where kind of maybe other fund managers or market participants are somewhat scared or somewhat cautious, has been really great times to find mispriced companies. So I think we've got our eyes firmly on that to say, given this macro context, let's keep digging for stock-specific bottom-up opportunities. As I said, we've had some great ones in this period. A few of those are touched on in our semi-annual letter, but I think there's been some great opportunities we've had, and I think there'll be more to come. So we're going to keep doing that, and I'm fairly confident that even in a more difficult macro environment, like the last 6 months has shown, there's definitely going to be opportunity to generate outperformance and alpha for a team that's highly nimble. I think our asset size allows us to do that, while at the same time looking for companies that'll benefit or that's still doing well, even despite the tough macro environment.
JP Morgan is quoted as saying that during bear markets, stocks return to their rightful owners. What he meant there is that we typically see capitulation as well as forced selling during these type of periods, and that results in share prices trading at very different values to the fundamental value of the business. And I think that's exactly what you're alluding to, Jacques, where we're saying we are well prepared, we have low net exposure at this point in time, and the team is hungry and actively looking for opportunities to exploit. So we hope that quote rings true for our performance over the coming 12 to 18 months.
It's certainly a great time to, I think, be managing a hedge fund where you've got this wide tool set available. When we've aggressively used our tools in the last 6 months, and I think it's going to be probably more so in the second 6 months of the year as we see how this plays out and as we see where the Fed gets interest rates to globally.